Greetings everyone. I'm your facilitator Rajat Kush, and today we are going to talk about futures pricing, margining, and settlement process. I've divided this training into three modules. In this module, we are going to talk about futures pricing, and in the second module, we'll be covering about futures margins and margin calls and settlement process. So let's start. First of all, this is a perception that the future price for any asset, for any underlying asset, the future contract price is just a market perception. This is somewhere true, but not exactly true, because if you want to calculate the future price, this is the formula for that. You take the spot price of the underlying asset and you then add cost of carry. Now, what is cost of carry? It includes net financing cost, storage cost, insurance cost, other related transaction cost, and any positive returns on the asset during that period. This is nothing but your risk-free rate at the market. These mainly apply to commodity futures, and remaining they apply to all kind of futures, be it financial future or commodity futures. Let's take an example. Let's say the spot price of a copper is $1,000 per lot. Okay. Now the market interest rate is 6% per annum and the storage cost is 1% per annum. So now if you want to calculate the price for a 3-month futures contract, what you need to do is you start with your spot price and then you add your interest cost and storage cost. So this is the interest cost, right? So for $1,000, 6% interest rate for 3 months, it will give you $15. And regarding storage cost, same $1,000, 1% of this for 3 months will give you $2.5. So your total futures price will be 117.5. So spot is 1,000 if you want to take immediate delivery, or if you want to take delivery in future, or even if you want to do cash settlement for 3 months. So you will pick up this contract. So question, cost of carry does not include what? This is included, this is included, this is also included, but future loss in a trade is not included. So as I mentioned before, returns, the positive returns of the assets are included, but not the losses. Now there could be two kind of markets. What do we mean by contango and backwardation? Either your future price is going to be more than spot, or your future price is going to be less than spot. So if the cost of carry is positive, that means the future price will be more than the spot, because future is spot plus cost of carry. So here in this example, your future price will be going like this. For example, 3 months starting today, and this is your spot price. So at the end of 3 months, they will both converge. They have to be same at the end of the maturity, correct? In case of a backwardation, your cost of carry is negative. So your future prices will be below your spot price. And by the end of maturity, they will converge together. So this is your future price and this is your spot. Now, future prices on a stock index, how do we need to calculate them? So a stock index can be usually regarded as the price of the investment asset that pays dividend. So you assume that this stock index is nothing but a portfolio of stocks, all right? And then these stocks, certain stocks, not all of them, certain stocks might be paying some dividends, correct? So what you do now is, this is the general formula. Okay, let me down the generic formula for calculating future price. So spot price raised to the power as an interest rate, rates to the power interest rate multiplied by your time, correct? But in the index, there is this minus Q. What is minus Q? Minus Q is your dividend yield rate. So since you're getting dividend, it is going to reduce your overall cost. So future prices will be reflecting this reduction in the overall price or overall cost. Let's take an example. So we are looking at a 3-month futures contract on an index. Now this index provides a dividend yield of 1%. So our Q will be 0.01. The current value of the index is 1300. So this is the spot price of the index. And the continuously compounded risk-free interest rate is 5%. So E is 0.05, or rather R is 0.05, E is raised to the power R. So to calculate the future price, you take the spot price, continuously compounded with the compounded interest rate minus your dividend yield multiplied by your time. Since this is a 3-month contract, so 3 divided by 12 is 0.25. So 0.25 is nothing but 1/4. So based on this formula, the future price of the index for 3 months will be $1,313. So in summary, fair future price is equal to the spot price plus cost of your carry. Now, cost of carry includes all these elements, but all these elements may not be applicable for calculating future price of every underlying asset. For example, storage cost and insurance cost will not be applicable if you are calculating future price for, let's say, stock or a bond or an index, right? So these two costs will not be applicable when you are calculating future cost for stock, bond, or an index. Markets are in contango when future price is higher than spot price. So again, I'll repeat, contango means that your cost of carry is positive. So if cost of carry is positive, then your future price is what? It's spot plus your cost of carry. So X plus Y, right? So in this case, your future price will be above your spot price. But at the end of the maturity, be it 1 month contract you are looking at, or 2 month or 3 month, they will converge together. So on the last day, at the last minute, they will be exactly same, right? Or very close to same. In case of a backwardation, cost of carry is negative, and this is the reason your future price is going to be less than your spot price. So spot price will be going like this, future price will be going like this, and end of the maturity, they are both going to converge together. So this is the end of our first module. Hope to see you in the second module of this training.